a little bit about Commerce Street while he's bringing that up. I don't want to spend too much time on it, other than I want you to have some perspective so that this is an open forum. You can ask me questions before or after the discussion. And I enjoy that. That makes it a little more interactive and hopefully more value add to you. Commerce Street's the largest independent investment bank in Texas. Think of it as an investment bank on one side and an investment firm on the other side. The investment bank, half the business is in the banking industry. The other half is agnostic: energy, real estate, healthcare, manufacturing, technology, whatever we can figure out and hopefully add some expertise to. We do a lot of M&A, a lot of private capital raising, some sponsored equity on that side. We'll do lots of co-investing opportunities, and we even do some select third-party marketing of funds that we've invested in. We invest in everything that we're doing, think merchant bank. And I really don't like the third-party marketing business. It's extremely hard work, right? It might be the hardest work there is out there, but we do that, and we've had some success. And so that works for us. On the investing side, we started and cut our teeth in the banking industry, doing our 11th fund now. Always have a bank fund or opportunity in the marketplace. I've invested over $1 billion in the bank space, $2 billion in SBICs currently, all of them mezzanine, senior stretch, or private equity, or combination thereof, all over the U.S. Very, very good active business for us. And I think we're the largest sponsor of SBICs in the country. We're fastest growing retirement provider in the 401k business in the state of Texas. Great product there. We do some outsourced CIO. We do some outsourced alternative asset management. It's all cafeteria style, depending on what you need, separate managed accounts, all kinds of neat things going on in Commerce Street, and which leads to the broad perspective for today's discussion, which we should have titled, instead of economic outlook, I'm not an economist, an economic, let's call it economic investment outlook, and maybe hopefully be a little bit more practical. So if you can hit the first slide up here, general information. That's my compliance officer, right, saying don't believe anything this guy says, or at least don't hold him liable for it, or the firm liable. Next, yeah, keep going. And that's all about me. Great. Next. Okay, go to is that the first page? Okay, let's just talk S&P and profits right now. You know, a couple things to really watch for the economy. One of them being earnings, right? We got to watch the S&P earnings. The market's all about earnings, and that's how the market prices. And the market moves around based off the fluctuations of the expectations of those earnings in the future. And earnings have hung in there really, really well. Now, they've been lowering the expectations on those. And you know how the market works. I think we forget sometimes. The analysts get a whole lot of coaching from the companies. And so by the time they announce, you know, the hit or miss is pretty close. But what you can track on that is, A, how much are the earnings forecasts coming down from the analysts? And B, how much is the earnings surprise from the companies? And what's been happening is the earnings forecasts have been coming down at a faster rate, and the earnings surprise are getting to be lower and lower and lower. So far, the 20% of the companies that have announced this quarter, the earnings surprise is the lowest, and the performance is the lowest it's been since 2020. So it is coming down, which is good. Okay. Now that's where the market is getting really, really confused. The market is looking for good news. It wants an end to these rate hikes. It wants things to be rosy. So some days, and I think some of you remember this one day, we had a bad number on the purchasing managers index, and the market went down like 500 points. And then about midday, the market was sitting there and it went, hey, bad news is good news, because that means the Fed's going to stop hiking rates. So then it went up like 800 points. And I think that's what the market's caught in right now. It's so caught up in wanting these rate hikes to be over that it's not sure where to go. And part of it is a bit unrealistic. And we're going to talk about some of that today. Go to the next. Yeah, I have no idea how to make them bigger too. And I got to tell you, I'm kind of winging it because I can't see that far. I've got progressive lenses. So if I'm nodding, it's not because I necessarily agree with you, it's because I can't see. But this is back on the earnings growth again. So those are just some data on there, how that's been decreasing. Go to the next page. Okay. I don't know what it is, so I got to get up and look at it. What did I pull this up? This is the corporate high yield to worst. Okay, so one of the things to watch out there, and I think most people agree that are good market watchers, is stock market is always a question mark. It doesn't know where to go. We just talked about it, right? Bond market always knows. Bond market always knows. Always the best fixed income guys out there, the traders, the forecasters, those are the people you really want to listen to. And one of the things you want to watch, obviously, is corporate high yield. And the high yield spreads have been coming up again, as you can see over here on the right. Now, the problem is if we're looking for a forecast, right, this would be recessionary periods. They're coming up, what, late? Come up late. You know, are we already in a recession? Or is it going to come up higher and then we're into one, right? You know, we had 2 negative quarters to define a recession. GDP now is forecasted, I think, at 2.8, but they've been very wrong in the early quarters of their forecasting. They'll have a high number and then it tends to come down towards the end of the quarter. So I'm not sure how reliable the early numbers are. But high yield, you know, recessions, you typically are halfway through one by the time you realize it, right? Because the numbers are all lag. I need a leading indicator. But one of the things we have is banking, which we'll get into, which helps. But keeping a number and keeping an eye on high yield is extremely important because that market will start to soften and widen way more than all the other areas, not just because of spread widening and interest rate risk, but because that credit risk, because it shows up there. The lower grade high yield bonds blow up faster than anything, and the returns can be really awful depending on how bad a recession is, which is another thing I think we need to focus on here. A lot of people go, are we going to have a recession? Are we going to have a recession? Yeah, we're going to have a recession. The Fed wants us to have a recession. That's a good thing. I see so many pundits get on TV and go, doggone, Jay Powell wants us to have a recession at the expense of jobs, this, that, and the other. I'm like, yes, he does. Do you know why? Because runaway inflation is worse. It's worse. We don't want to be Venezuela, right? So we have to have a recession to snap it down. So I think there's a big misunderstanding sometimes out there with people. Yes, we want a recession. The trick is we want a mild recession. We don't want a bad recession. And I think we're on course for a mild recession. A mild recession would be something more like 2000 versus, say, 2008 or the early 90s or late 80s, right? And what's the key to that? Banking and credit. If credit is underwritten well, you'll have a mild recession. If credit is underwritten terribly and the banks fail, you'll have a hard recession. That's the difference. And right now, the banking industry looks extremely well. We'll get to that in just a minute. Go to the next page. What is that? Oh, yeah. So this was a Credit Suisse, something to keep on my eye on. So we mentioned banking, right? So everyone saw that credit default swaps of Credit Suisse went nuts. And now it's all of a sudden quiet. Everybody was talking about rumors. Oh, are they going to fail? Are they going to fail? We definitely have to watch it because that credit default swap market, it is huge. And what the foreign banks did relative to what we did is really tragic because after 2008, we put trillions into our banking industry in the capital sector. And up until a couple of years ago, all of them were running 8 to 10% tangible capital equity ratios. The foreign banks never did that. They never got up there. They stayed anywhere from 2 to 4% tangible capital ratios. Now, I want you to think about that a little bit. You're running a spread business. Anybody know any hedge funds that operate with that much leverage? No, they don't run that. Maybe they run 150 to 200 if they're equity neutral, maybe a little more. But they don't run at 20 to 1. right? That's long-term capital. Who brought up long-term capital? That's what they do, right? And they don't make it. All it takes is one little black swan or bad standard deviation event, and you're blown up. Banks are the same way. They're a spread business. When they run off 2 to 4% cash tangible capital versus 8 to 10%, it's a big deal because the market moves what 1 to 2 to 3 to 4%. And if you do, your capital's gone immediately in a mark to market. Okay, Europe is looking at that right now. They got big problems over there. They got runaway inflation. They got big energy problems over there. And they got big debt problems in the banks. And the banks were never capitalized the way they were supposed to be 15, 14 years ago. And now they're not cushioned enough for big problems. So watch European banking and watch this bank in particular, because it seems to have the first headwinds of problems. The UK system, right? You saw what happened over there with the prime minister over there didn't even make it longer than lettuce in your refrigerator, right? I mean, she gets in, says, we're going to do this, and boom, they got a pension crisis, money crisis, and they can't do what she wanted to do, so she quit. And wow, that's I've never seen anything like that. So that's pretty amazing. So the problems in banking, if they will start over in Europe. Okay, the problems here aren't as bad. There's good and bad in the banks in the U.S. Let's talk about that for a second. Now, bringing up the banks, not necessarily for investing, it's just that they're the plumbing and wiring of the system, and it's where problems start first, and it's where recovery start first. So when we look at this, well, the quarterly Fed outlook just came out. It comes out and you can look. And there's several headlines out there. Solid loan growth, even with the sector consolidation, continued M&A. Asset quality remains exceptional, but likely to deteriorate modestly going forward. The asset quality, the credit underwriting in banks is the best I've ever seen it in 40 years. It doesn't mean that some banks haven't been aggressive, but the box that's been allowed to underwrite in banking is tighter than it's ever been. And part of the benefit and the rise of private credit business is because of that. Okay, that's good and bad. It's good in that it makes a better flowing economy. It's bad because everything outside of banking is unregulated and untested in a really bad market. So I'm very concerned about that. And I think we have to be careful. We invest in private credit. We just have to be very, very careful. And what does everyone, the managers tell you? We're very, very conservative and we underwrite very, very carefully. Unfortunately, that doesn't differentiate any of them. Okay, so you really have to know the terms and what they're doing and really to have good credit people doing your due diligence. So on the bank side, so this, it says asset likely to deteriorate. We saw two different things in this curve. The first thing we saw were the big banks that have reported so far have showed losses versus the community banks, which are showing gains. All of them are showing increases in loan loss reserves. Loan loss reserves doesn't mean you have loan loss problems. It just means you're increasing reserves in case you do have problems. We want that from banks, but that's a sign that there's a recession coming, right? They try to get in front of that. And it also is a self-fulfilling prophecy to some extent because banks start tightening credit in anticipation of a recession, and that does that. Go ahead. The community banks, which is interesting, the offset in net interest margin is bigger than the increase in loan loss reserves. So one of the things that's misunderstood out there, I'll see on TV, when rates are coming down, they'll say, oh, net interest margin contracts. And then rates will go up and some of them will say, well, interest margin widens or contracts. Volatility creates increased net interest margin because banks have a lot of control over the pricing of their deposits and the pricing of their assets. So a lot of people fail to understand that. When you have a long period of time when rates are stable, then things get very efficient on the pricing of the loans and the deposit. They become very inefficient with volatility. Volatility in rates is actually very good for banks, in spite of what you may hear out there. They have marks to markets on their portfolios, but the rest of the bank is not mark to market. And so they're not in the securities buying business. They're in the spread business, and they manage that spread, and they do it very effectively, and they do a good job because most of it's on the short end of the curve. But that's why the community. Pardon me? The volatility? No, or borrowers, right? Yeah. Yeah, that's gonna choke people. That's a great statistic. I didn't know that. So capital, I brought this up earlier, had been running 8 to 10%. I have a concern now because the large big banks are running closer to 5%. I'm talking the holding company level. So you may talk to a banker, but they've been gorging on holding company debt, including a lot of the community banks. So it's made us very cautious as investors because of, again, if we get a 1 to 2 to 3 or 4% change in the market, I don't want that capital be so diluted that they have to raise more capital, which is even more diluted. And that's terrible for investors. So they may have plenty of capital at the bank level. I don't think banks have enough capital at the holding company level, including the big banks, with the exception of Wells Fargo, which is the only one that's above 7%. All the others, I think, have levered way too much. And so it's made me very cautious on those banks that don't have a lot of capital. At the end of the day, the way you make money in a downturn market with banks is the capital is king. It gives them a regulatory green light. They can acquire banks, they can grow, and they can acquire problem banks. If you don't have capital, business runs from you, the regulators squeeze you, and things get very tough. Profitability increased due to higher rates. Okay, I brought that up. The deposits have been very stable, which has been very interesting. We'll see. Banks don't know if their deposits are stable or not. We've never been in an environment like this, or at least we haven't in 20 years, right? So we had 351 basis points increase in the 1 year in 1994, and rates have kind of done this for a while, but nothing like this for a long time. So we have a whole generation of bankers and depositors and whatnot that have not seen this. So when a depositor has a money market account at 10 basis points in their bank, they have options, right? They can go get 4.5% on a 2-year treasury. They didn't have that option before. Or they can find another bank. My favorite thing to do is to sit with a bank and go, I got $5 million. What will you pay me on a money market? Some of them pay me 50 basis points. Some of them will pay 3%. It's extremely inefficient. The cash market is extremely inefficient right now. You can look in your brokerage account. What does it pay you on your cash? Nothing, maybe 10 basis points, right? But there are banks out there that will pay you 3%. Sallie Mae will pay you 275. It's a government agency. You can have daily liquidity. Cash is the most inefficient thing out there right now that I see in all the markets. All of us are doing alternative assets and this, that, and the other and everything, but manage your cash. And we're helping a lot of people with that because it's amazing. That's free alpha, right? We kill for 100, 200 basis points of free alpha, and that's out there in cash today. Next page. So this is basically talking about turning points of the VIX. Well, I've watched the VIX a lot. Greed and fear rule the market. I need a fear indicator, okay? And they're very helpful for short-term turns. They don't tell me when the recession is, but they help me with short-term turns when the market's overdone it. So when that thing gets a couple standard deviations, which is 36, that's a really strong buy. Or maybe if it's hanging around 32 to 35 for 4 or 5 days, that's a really strong buy. And it worked again this last time. We've had 3 times this year. We had in March and June, I think. And then the last few week, boom, it's popped up. It's been really good buy. So if you're a trader, you want to make money, those are good, strong buy indicators. VIX is still right around 30 right now, which is high, above 1.5 standard deviations. So keep an eye on the VIX. Next page. All right, this is more of an indicator that we might be looking at. I know the Fed is. So this is wages, right? Or unemployment. No, wage and salary workers 16 and over. And it really doesn't give me much of a leading indicator. We know the Fed's concerned about it. We know they've been talking about it. But for me as an investment guy, I'm like, okay, I'll watch that number. I know the Fed looking at it, but it doesn't tell me when. Go to the next slide. So this is a little bit on CPI, tracking with Fed funds. And you can see they normally track pretty well together. And now there's a big spread here between CPI and Fed funds. If we go back to 1980, which is a real key one, we can see we popped way up to get way above the CPI. So you got to be above CPI to get there. Now, one of my concerns is inflation's been pretty high. And is it being properly measured? So do we have Fed funds high enough? Because we know what Paul Volcker did. He went to 20% to stamp it out. In order to do that, we got to have that same commitment. I don't know if we still have that commitment as a society or as a Fed to stamp out something if it gets that strong. But we do know that inflation's probably higher than what they're reporting to us because we're seeing it all around us. Anybody paying $30 for fajitas? Yeah, it's you kind of gulp on that. Wow, pretty expensive. Next page. This is the unemployment rate change. This is a perfect example, if you look in the gray areas, that by the time the unemployment data comes out, you're halfway through the recession. Okay, so that doesn't tell me what I need to know. Next page. This is a little more helpful to me. I like to watch the term structure of interest rates, spread between the 2-year and a 10-year. And if you'll see that, I get a little bit more of an indication that it happens and the rise happens a little before the gray areas happen. And so we're starting to see that. The inversions last, I remember the 1989, it lasted 9 months, okay? So we've had a little inversion for now. Some of the other inversions have lasted a little shorter, a little longer, but not a whole lot of difference. So the inversion should tell you a lot. We got an inversion, which tells us a recession is coming. At those last for a little while until the recession starts, and then you'll be halfway in one. The good news is recessions don't last that long. Usually a couple of years, depends on. But the question is how bad is it? So if we have a mild one, it shouldn't be too bad, and that gets us back to the get-go and what we were talking about. Maybe the market is not expecting a bad recession. And that's why it's so eager to be optimistic, to look for the end of the rate hikes. The question is the market right? And I don't know I'm ready to buy that yet because everything's back to what? On credit. And I gave you some good news on credit, but what I don't know is if there is bad news outside the banking system and an untested private credit market, because that could wreck the whole thing. That's a perfect example. Look at all the leverage that's out there in crypto. Young people never seen a really bad market or down market. And where does that eventually show up? A bank say we don't do crypto, but then they lend to somebody that does. Or banks may say, well, we don't lend to that type of credit, but then they lend to a private credit fund that does. So in a sense, it shows up in the banking industry, right? So how are these things funded and where do they get their money from? And that's a big thing. Where does it, because when liquidity dries up, it dries up. And one of the things that was interesting when we had a hedge fund in the last crisis in 08 is we didn't have gates, right? So everybody was real negative on hedge funds unless they got gates. So hedge funds woke up and said, you know what? We'll get gates and it'll solve the liquidity problem. And what a false sense of security that is, because people don't realize that the hedge fund or a private credit fund or a crypto fund, anything levered does not determine liquidity. It's a function of the funding and the market for that funding. and that determines the liquidity. The hedge fund has no say over it, nor do the other vehicles. So I'm always shocked by investors that are looking for something with liquidity features or this, that, and the other, and they take that as gospel to meet their goals. It'll meet their goals until it doesn't. and that's in a real severe downturn. And that's when you may want it the most. Now, a lot of times it'll protect the investor from themselves and keep them from liquidating. So that's probably a good thing. All right. I think that's it. Is that it on there? Okay. How much time do I have? I want to hit some other stuff. 10 minutes. Okay. So a couple other things. All of you have probably seen an election analysis. I'm not going to go through it in detail. I'll just say there's a 52% probability of the Republicans taking the House and the Senate, according to the betting odds, which is probably better than anyone's forecast. It's been pretty rare. I mean, like Trump lost 40 seats, Obama lost 63, Truman lost 55, Clinton 54. When you have bad favorability ratings, and that's what Biden has now. So I don't think it's unrealistic to lose 10 to 20 seats, which would throw it into the Republican side. On the Senate, you're looking at something where it's probably like last time. If the Republicans gain Nevada, then Georgia is the toss-up, and they've got a third-party candidate, and now you're going to have a runoff. So that's probably what's going to happen there. But from the investing side, a few statistics. In the past 6 decades, the average intra-year, which would be this year, decline in the S&P in a midterm election is 19%. Oh, we were running 24, 25, right? So, okay, we hit that. That midterm volatility is followed by an average in the next year of a 32% gain. So I was visiting with somebody on the way in about, keeping clients steady and not pull out of the market at the right time. That's a perfect statistic for something like that. Year 3 of a presidential cycle has not produced a recession in any period since 1929. So that's contrarian to everything that I'm telling you, because I think we'll probably hit one next year. So maybe that's a data point for a mild recession. I don't know, but I thought that was kind of interesting. It's kind of, the other thing I want to talk about is what are we doing? What are the implications for some of this stuff? I told you about cash, so you get that, start there. Stocks, we're under allocated in stocks. We're over allocated in the US. We like small caps right now. They're trading at a 11 PE versus Russell 2000, which a third of the companies still are unprofitable. And the PE there is 18. S&P is about 15.5 right now. So good conservative small cap stocks are a good place to be, but there's still a good value in energy and consumer staples and financials, where also those sectors are heavily focused where in the US. So there's less dollar risk in other areas in the world, which I think is a good thing to do right now. Bonds, high quality, short term, no rocket science, but don't fall to the past temptation of running everything short on your bonds. You got to stick to a discipline. I still remember people, and if you talk to older bond salesmen in the early 80s, they try to sell a 10-year treasury at 10%, and somebody would laugh at them because they're getting 20% in Fed funds, but they only got it for a short term. The 10-year treasury at 10% was a pretty good deal. Pretty good deal. So you got to keep with your ladder and your discipline. Private equity, obviously there's too much money out there. People have been raising money like crazy. How are they going to differentiate themselves? How are they going to get their buyout leverage? We're focusing more on growth and smaller strategies and lower leverage and niche areas. Private credit, we talked about the concerns there. So we do very heavy underwriting in that area. Real estate, rising cap rates. I'm getting deals on my desk at 3.75 and 4% cap rates, and I'm just kind of throwing them out the window. It doesn't mean that their forecast is wrong. I just think it's a credibility issue with the guy showing up with that. I had a guy show, you get a Frisco deal or downtown Austin or something down here in Turtle Creek or whatever, it's probably going to be a good deal, but don't show up with 40% IRR and 3 3/4 cap rate. Show up with 15% IRR and a 6% or 7% cap rate, you get more credibility. And I think you will with the investors. People still need to do real estate, but just need to be very, very careful. We're still very active in selective industrial markets, industrial warehouses, doing some multifamily. We're just very, very picky on location. Maybe we add it a couple more times. We are over allocating hedge funds now for the first time in 10 years. Love the cash bond stock alternative in hedge funds, equity market neutral, Millennium and some of these other guys that have been around a long time. We're doing some good fund to fund work in there where we're just trying to get a return in case everything goes down, right? And there's some good players out there. A lot of guys have straightened themselves out, and this is a hedge fund market. And this whole year has been a hedge fund market. Yeah, I mean, we've got a fund of funds where you can get in to Millennium, but you can't, it's hard, some of them you can't get into. So we have some access into some of these. But yeah, you want to be with a long-term player that's been around, and I'm not looking for what I call gambler hedge funds that can make big IRRs. I want somebody that's hedged. I want to hedge out correlation risk in other areas. So we like that. We love energy. What a contrarian play. Maybe the biggest contrarian play that we've seen in 35 years. Incredible. Oh, it's ESG. It's bad. We don't like oil. We don't use oil. It's horrible. Everything's going to batteries. I mean, everybody's seen all the contrarian argument against that. And it doesn't make sense. It's all great and noble to be green, and that's terrific, but it's not realistic in the time frame that the market or people are trying to expect. And so you go do stupid stuff like Germany and say, hey, we'll get all of our gas from Russia. That's a great political move. I mean, a monkey could have seen that was a dumb idea. And it's amazing. And Trump told him that, but he probably didn't use enough decorum in doing so. And so they told him, get off. You don't know what you're talking about. And he turned out he was right. And too bad he didn't have any niceness in his way to say it, and they might have learned. But we love energy right now. Great opportunities there to do good, high quality, low risk deals. You can buy Pioneer stock right now. I was on Fox talking about it, and it went up 50 points in 2 days. Not because of me. It's just a great deal. It had 16% dividend yield, very low cash, and the biggest presence in the Permian out in Midland. And the more that they try to limit drilling in other places, the better the Permian gets. So there's a lot of opportunities out there. There's some consumer staples out there. You look at Walgreens, close to 6% yield, 6% PE. That's stuff people still got to go there. We still love technology, good, high quality technology. We're not running from that, but what we are running from is the no profits model, or the high overvaluation model, or the hype model. We're looking for good quality stuff. We're the first company doing blockchain in banking and commercial banking, bank to bank business. Not Venmo. That's public blockchain. This is private blockchain, and it's already doing more transactions a day in Zelle, and we're only in 3 banks, and we got 50 more lined up. So there's some great opportunities out there. Any questions? Yes. Yeah, I think companies have been in denial about China for a while. And I had some get mad at me when I was in 2019, 2020 on CNBC. I was bashing China. But basically I was bashing the companies that are doing all their supply chain stuff out of China. I just thought it was extremely myopic to not consider political risk in your supply chains. And whether that be Apple or Micron or Nike or whoever it was, go where there's less risk. Go to Indonesia, go to Vietnam, go to India, and all of those have been huge benefactors in the last 3 years. And I don't know why I would change my view and go, okay, well, I'm going to go back to China. China has they just reelected their president. The President Biden, who, when he took office, you'd probably vote would be what, super friendly to China? I'm not seeing it, right? So I don't see any reason to be wanting to have big supply chains or doing anything in China, because I don't see how that's going to change. And China's certainly not changing how, making any waves or motions whatsoever that they want to do business on American terms. If they come here, you know, like I said, they may be in India or some other places which may be cheaper than here, and that's fine with that. It's just a proper assessment of the political situation. So if I'm a Fortune 500 company and I'm doing chips or this, that, and the other, hopefully you learn your lesson and don't do all that in China alone. Maybe you pick 3 or 4 or 5 countries to do this in and mix it up just in case one of them, you know, gives you trouble one day. A huge contraction. You know, we're watching the 10-year and a lot because, you know, there's this big talk of there's not enough buyers out there right now. And so that could be a big liquidity drain that we haven't seen in a while. Because we do see a lot of money out there in consumers. We see a lot of money out there and locked up in private credit and private equity and big liquidity features out there. But foreign and abroad, there's the liquidity sources drying up, and we're hearing a little sucking sound of kind of like Ross Perot used to say. We're hearing a sucking sound coming out of China and out of Europe. Mm. I don't have a recommendation on that right now. I don't know what it's trading at, to be honest with you. Yeah, the one of them is Signature Bank in New York, SBNY. They've grown from about $20 billion bank, a very conservative commercial bank, not known for technology. Well, they were our first client. They white labeled it. They call it Signet, and they've grown to about 140 billion. And the hardest business for a bank to get is commercial business. So they come to your law firm and say, we want all your deposits. We want your operating account, this, that, and the other. Or maybe a family office. And think of this, hey, no ACH, no wire, 24/7, safer, easier, no fees. Boom, people move their business. And the regulators love it, the banks love it, the customers love it, and they're doing billions and billions of dollars in transactions. There's a, I don't want to call it a Chinese wall, but there is a big old wall between their opinion on blockchain and crypto. They are anti-crypto and they are pro-blockchain. Okay, they're just careful about it. I got hearing aids. Oh, the war in Ukraine. I didn't hear that last part. You know, it shouldn't expand here to the U.S., I guess, because I mean, we're already over there. We got tons of munitions, arms, and we even have people over there, which I think is very dangerous because, you know, it gives Putin the excuse to do something drastic. But having said that, you know, Putin's losing and he can't he's not going to make it through a long Russian winter doing this unless he does something drastic. As long as that's going on, it kind of makes a bad situation in Europe worse because of all the issues with wheat and farm and supplies and all that kind of stuff. I don't know what's going to happen. You know, I wish I knew. If you talk to generals, I've talked to a 4-star general at the Pentagon about it. He is adamant they are losing and we're going to win as long as Putin doesn't do anything drastic, right? Which is nuclear. So hopefully they can keep it from going nuclear. And I think that probably involves more prayer than anything else. And perhaps assassination. You know, you got all kinds of people trying to take him out. and I wouldn't rule out Russians taking him out.